Before you look at your first real estate deal, you need to understand three numbers. Not 20, not some complicated spreadsheet with color-coded tabs. Just three. Because if you're brand new, the goal isn't to become a financial analyst. The goal is to know enough to avoid the obvious mistakes. And most bad beginner decisions happen because someone likes the property before they ever check the numbers. They like the price. They like the neighborhood. They like the seller story. But real estate doesn't care how excited you are. The numbers either work or they don't. If you're new to real estate investing, deal analysis can feel overwhelming. You hear people talk about ARV, cash flow, repair budgets, cap rates, hard money, equity, assignment fees, rent comps, exit strategies. Then someone shows you a spreadsheet with formulas and it feels like you're already 3 steps behind. So you either avoid the numbers completely or you trust someone else's numbers because they sound confident. And that's a problem. Because if you don't understand the basic math, you can't tell a difference between a real deal and a bad deal dressed up in nice language. So today, we're keeping it simple. 3 numbers: value, cost, margin. If you understand those 3, you'll be much harder to fool. The mistake most beginners make is starting with the wrong question. They ask, can I make money on this? And that sounds right, but it's too vague. A better question is, what is this property actually worth? What will it really cost me? And is there enough room left over to make the risk worth taking? That question forces you to slow down. It forces you to stop looking at a deal emotionally. And it keeps you from thinking a property is good just because the seller is motivated. That house is cheap, or someone online says the market is hot. Real estate investing isn't about finding properties. It's about finding numbers that make sense. I'm the insider. I built Seminar Insider to help new real estate investors understand the business before they overpay for coaching or high-ticket seminars. But the most important protection isn't just knowing how seminars sell. It's knowing how deals work. Because once you understand the numbers, the hype loses its power. You stop needing someone to tell you if a deal is good. You can start seeing it for yourself. Now, number 1, value. Value is what the property is realistically worth. This is the number everything else depends on. For a flip, this is often called ARV, or after repair value. What the property should sell for once it's fixed up. For a rental, you care about what the market will actually pay each month. Either way, you need to know what the market supports, not what the seller wants, not what the listing says, not what online estimate tells you. The market decides value. The best way to estimate it is through comps, comparable properties that recently sold nearby with similar size, similar condition, and similar bedroom count. If you're looking at a 1,400 square foot 3-bedroom and you compare it to a renovated 5-bedroom across town, you'll get fake confidence. Bad comps create bad decisions. If your value is wrong, everything else is wrong too. Number 2, cost. Cost is everything it takes to buy, fix, hold, and exit the deal. This is where beginners underestimate almost every time. They think cost means purchase price. But purchase price is just the start. Flipping, add repairs, closing costs, loan fees, interest, holding costs, commissions, selling costs. Buying a rental, add your loan payment, taxes, insurance, maintenance, vacancy, management, and reserves. Wholesaling, you still need to understand your buyer's full cost because your buyer has to make money after they pay you. Now here's why this matters. A house is worth $250,000 fixed up. The seller will take $170,000. That sounds like an $80,000 spread. Add $45,000 repairs, add holding costs, add financing, add closing and selling costs. Suddenly, that $80,000 spread isn't $80,000 anymore. That spread isn't the profit. The spread is the starting point. Real profit comes after real costs. Now, number 3 is margin. Margin is the room between your total costs and your expected outcome. If the number that tells you whether the risk is actually worth taking. For a flip, your expected profit after all costs. For a rental, your cash flow after all monthly expenses and reserves. Or a wholesale deal, whether there's enough room for you, the seller, and the end buyer to all come out ahead. Margin matters because real estate rarely goes perfectly. Repairs come in higher. Timelines run longer, rents come in lower, buyers renegotiate. If a deal only works when everything goes right, that isn't a beginner-friendly deal. You want room to be a little wrong and still survive. That doesn't mean you have to be scared of deals. It means your margin is your protection. Now here's the core idea. A deal isn't good because it looks cheap. A deal is good when the value is real. The costs are honest. The margin is strong enough to protect you. If you want help avoiding these mistakes before you make your first major investing decision, download the free seminar survival guide in the link below. It'll help you slow down, asking better questions, and stop making decisions under pressure. Now let's make this concrete with 2 quick examples. Let's start with a flip. A house is worth $250,000 after repairs. The seller wants $150,000. Repairs estimated around $45,000. Holding, financing, closing, and selling costs at additional $20,000. The total cost is $215,000. So the margin is $35,000. Now stress test this. Repairs come in $10,000 high. Margin drops down to $25,000. The property sells for $240,000 instead of $250,000. Now you're at $15,000. Both happen at the same time, and the deal barely works. That's why you can't just run the happy version. You have to run the conservative version. With a rental, property rents for $1,800, mortgages $1,100, taxes and insurance are $300, maintenance, vacancy, and management an additional $300. That total monthly cost $1,700. Your cash flow is only $100. That sounds positive, but one repair can wipe out a year of cash flow. One vacancy month can wipe out 18. The question isn't just, is it positive? The question is the margin strong enough for the risk? That is beginner deal analysis. It's not complicated, just honest. Now here's the insider breakdown. Here's what they showed you. The clean version. Purchase price, ARV, repair estimate, potential profit, or rent minus mortgage, and they call it cash flow. Simple numbers that are easy to follow. That's exactly why they work in workshops and on stage. What they lead out: closing costs, selling costs, loan points, taxes, insurance, utilities, vacancy, repairs beyond the initial estimate, property management, reserves, what happens when the timeline runs long. Once those missing costs are added back in, the deal looks very different. Now, what you actually need to know: don't analyze deals with best case numbers. Use conservative numbers. Stop asking, how much could I make if everything goes right? Start asking, does this still make sense if I'm a little wrong? That one shift protects you from a lot of bad decisions. Here's a simple tool to take with you. Every time you look at a property, write 3 words: value, cost, margin. Under value, what's it realistically worth, and how do you know? Under cost, every expense you can identify: purchase, repairs, closing, holding, financing, selling, operating, reserves. Under margin, what's left after real costs. Then stress test it. Repairs 20% higher, sales price 5% lower, 2 extra months on the timeline. If it holds up, it deserves more attention. But if it only works in the perfect version, be careful. Before you worry about advanced strategies, learn 3 numbers: value, cost, margin. Those 3 will help you understand flips, rentals, wholesale deals, and almost every beginner real estate conversation. They'll also help you stop being impressed by vague claims, because when you know the numbers, you can ask, what's it worth? What will it cost? What's left over? And is that margin worth the risk? Again, download the free survival guide in the link below to protect yourself from the pressure that catches beginners off guard. And when you're ready to go deeper, check out the vault. In the previous video and this playlist is what you actually need to learn before your first real estate deal. That one lays the foundation before you start chasing deals. Next up is how real estate deals actually work, because once you understand the three numbers, the next step is seeing how a deal actually moves from the seller problem to closing, and that's where it all starts to click.